Which life insurance do you really need? I'm going to share with you the 3 simple rules of thumb to help you calculate your actual need that is most suitable for you and your family. So let's go ahead and dive in and get into specifics. But as we get started, I want to first lay the foundation and share with you what's the purpose of a life insurance. A life insurance policy is a contract between yourself and an insurance company that for a price will provide protection, peace of mind, and thus making your beneficiaries whole in an event that you pass. That's the most general definition for a life insurance. So obviously you're paying money so that in case that if something happened, your family's going to be made whole, that your family's not going to be in the streets, that they're going to be able to pay their mortgage, they're going to have X amount of years, your kids are going to go to college, etc. But it's a contract between you and an insurance company. The new policies nowadays, though, provide opportunities to be able to build cash value. So not only can you have the protection, but you also have an opportunity that while you're living, you could build up what's called a cash value account. And in some cases where they're mirroring the S&P 500 as an example, where you participate with the positive returns up to a certain point of the S&P, and you don't participate with none of the negatives. There's also fixed guaranteed rates as well in some similar policies. So there's potential for you to create supplemental retirement income if you structure them correctly and if you fund them as well correctly. Certain life insurance policies also have qualifying events in case if you became terminally ill, critically ill, chronically ill, or critically injured. Those are some examples of some of the living or accelerated living benefit riders that some of companies offer nowadays. So it's no longer that you have to die to be able to, use the policy. It's what if you get hurt or something happens that's life-threatening, and obviously depending on the severity of it, if it's a qualifying event, what if something happens and you don't die? Well, this policy will also take care of you. So powerful story there. And so life insurance has really evolved, and it's an amazing program or contract that could really be beneficial for you and your loved ones. So how much life insurance do you really need? So let's go ahead and dive into that, because that's really what I want to go into for the rest of this module. There are 3 rules of thumbs for you to consider that are extremely basic. The first rule of thumb is multiplying your income times 10. At bare minimum, you should at least have 10 times your income. That's almost almost like a no-brainer. It's like, hey, if something happens, at least give your family 10 years so they could, be okay for the next 10 years. The second rule of thumb, if you have children, you want to also do 10 times your income, but also leave at least $100,000 per child so they can help fund their college in case if you died prematurely. And then the third method is called the DIME method, or the DIME formula. So this is a way for you to calculate what exactly more or less you would need to have proper protection for you and your loved ones. So let's go ahead and jump into the first one. The first rule of thumb is 10 times your income. It's pretty basic, but we're going to go ahead and dive into the formula so you can see how simple it is. Let's say that you earn $100,000 a year. You pretty much take the $100,000, you multiply it times 10, that's going to be $1 million policy. At least, if you're earning that type of income, you need to at least have $1 million policy as your death benefit. Rule of thumb 2 is multiply your income by 10 times your income and then add $100,000 per child. So for instance, let's say that you have 2 children and you earn $100,000 a year. So what you're going to do is take 100,000 times 10 plus 100,000 per child. So in this case, it's 200,000. So that's going to give you $1.2 million in death benefit. So you at least need to have a policy of that size if that's your current scenario. Now let's go into rule of thumb number 3. This is called the DIME method. Obviously the D, the I, the M, and the E are acronyms for something. So I'm going to go ahead and share with you what that means. D is for debt and final expenses. So in the case that something happens and you pass, you want to make sure that you don't leave any liabilities, any types of debts, that they can properly bury you so that your loved ones don't have to worry about having that burden of all the debt that you leave behind or the final expenses for a proper burial. It's bad enough that, when you pass, that you don't want to leave that type of stress on anyone. And I stands for income. Normally, again, like I mentioned, it's at least 10 times your income. That's the most common, just rule of thumb, very simple. And you might have a larger need. So it's always got to be what's suitable as well. But very simple rule of thumb is you multiply it times 10. So I is for income. M is for mortgage. If you have a mortgage, say, of $500,000, you at least want to be able to leave enough insurance to be able to cover that mortgage so they don't have to worry about making the mortgage payment. And then E is for education, leaving enough money for your children to go to college. So that's known as a die method. So very simple, basic formula on how to calculate the proper insurance that you might need. So I know everyone has a need. So you might be thinking to yourself, well, what exactly do I need? So it's consult with a professional so you can get your options. Thank you.